�値just dropped a bold statement on CNBC. This AI rally still has years to run. And today, we're going to break it all down. 𝗗𝗏 is the head of research and chief investment officer at Fundstrat Global Advisors, and he joined CNBC's Closing Bell to explain why he thinks we're still only mid-cycle in this bull market, why lower interest rates are so critical right now, and what it all means for stocks, crypto, and of course, AI. In this video, I'll first show you the clip of 𝗗𝗏's interview so you can hear exactly what he said. Then, I'll give you my full reaction and break down the key takeaways. And after that, I'll share my own in-depth analysis of 2 AI stocks that I believe are built for the long haul. So if you only watch one video today, make sure it's this one, and stick around until the very end because you don't want to miss what's coming. Before we dive in, hit that like button. Let's see if we can get this video to 1,000 likes. Share it with a friend who's into investing, and drop your thoughts in the comments below. And if you haven't already, subscribe to the channel so you don't miss the next big update on financial markets and investing. Alright, let's hear what 𝗗𝗏 had to say.
First off, Tom, I want to mark a milestone because it is now a big anniversary day for Fundstrat.
It is indeed. It's our 11th year since we started Fundstrat, which was September 15th, 2014.
Blink of an eye.
It's a blink of an eye, yes, because this is still mid-cycle for the bull market as well.
All right, so since you said mid-cycle for the bull market, let's get right into the record highs that we are seeing. If it's mid-cycle, that kind of implies maybe 3rd, 4th inning, maybe 5th at the latest. Is that how you see things for this rally?
Yeah, I mean, I think some parts are later cycle, like part of the Mag 7 trade. But I do think AI still has many years to just propel earnings surprise and innovation and economic growth. So I don't think it's late, like it's too late. It's not too late to buy the Mag 7. But I think the next leg of this is really the Fed cutting, helps the ISM get back above 50, brings down mortgage rates, so it's a cyclical broadening trade. And then I think, financials I think are still important because I think that they're going to re-rate more like technology stocks. Goldman and JP Morgan are basically technology companies now. And as they embrace the blockchain, they're going to become more streamlined and less employee-dependent, much more AI-driven. So I think there's a lot to look forward to.
Now, if that is the case, you mentioned that it's because of a possible rate move lower and a trajectory of lower interest rates. Just how critical will it be to this market to have those lower interest rates? And do you think that there is a post-Fed playbook for what those companies are going to be?
Yes, I think it's really important for CEOs to be confident the Fed is cutting because we know the labor market has slowed, maybe even wobbling. And that's because businesses are cautious, and the ISM reflects it. It's been 31 months below 50. The Fed can actually re-inject confidence by saying we're back into an easing cycle. That helps businesses get confident and expand again. So there's a lot of legs to this if the Fed cuts, and I think it'll be a real improvement in liquidity.
You alluded to some of the places that could see the biggest impact.
Yes.
But can you take us through those? If you had to put a top 3 together about where you think the most activity or juice could come from if the Fed were to embark on this path. I think of maybe home builders. I think of other parts of the market, maybe technology based on valuations. But in your mind, what are the places that are going to reap the most benefit from that?
Yeah, so I'm looking at September 98 and September 2024 as the playbook, because those are both years where the Fed was on extended pause and they cut in September. The number one trade is NASDAQ 100. So I think that's why the Mag 7 and the AI trade gets a lot of lift off. The second is monetary liquidity sensitivity, global central banks easing. That's Bitcoin and Ethereum. And seasonally strong, I think they could make a monster move in the next 3 months, like huge. And the third, of course, is interest rate sensitives. That's really small caps and financials. But really, the first 2 might be the standout trades.
All right. Because you mentioned the crypto side of things, you're actively involved now. It's not just a thing that you're doing on the side. You are very much engaged in the business of crypto. You govern, you oversee crypto assets now. If we were to say Ethereum, Bitcoin, we try to bucket them into risk-averse assets or risk-on type assets.
Yeah.
Is it fair to look at them that way? We used to compare them correlation-wise to the NASDAQ 100. Is that the fair assessment for how these things trade in the coming months?
Yes. Bitcoin is particularly monetary policy liquidity sensitive. Ethereum has elements of being sensitive to liquidity, but it's also part of this AI moving onto the blockchain and Wall Street moving onto the blockchain and that whole stablecoin ChatGPT moment for crypto. So Ethereum, I think, trades almost like 1971 Wall Street, which was the dollar went off the gold standard, a lot of innovation. Ethereum essentially is a growth protocol, and that's why Bitmine is so aggressively acquiring Ethereum.
So right off the bat, Tom Lee reminds us that Fundstrat is celebrating its 11th anniversary. But what's really interesting is how he connects that milestone to where we are in the stock market cycle. According to him, we're still only in the mid-cycle of this bull market. That's important because when most people hear about record highs, they automatically assume we're near the end. Tom is saying the opposite. This rally still has years to run, fueled by earnings growth, innovation, and a recovering economy. Now, he acknowledges that parts of the market, like the so-called Mag 7 tech giants, are further along in their cycle. But here's his key point. It's not too late to buy them. He sees more upside because the next major driver is going to be the Fed cutting rates. Rate cuts, he argues, will push the ISM Manufacturing Index back above 50, ease mortgage rates, and kick off a cyclical broadening of the rally. Translation? Instead of just big tech leading the charge, we could see financials, small caps, and other sectors come alive. And speaking of financials, Tom makes a bold claim. Companies like Goldman Sachs and JP Morgan should be seen as technology firms now. Why? Because they're leaning heavily into blockchain and AI, making them less employee-dependent and more streamlined. That's a massive shift in how we categorize banks. If they start re-rating like tech stocks, the upside for financials could be significant. Tom stresses that the Fed's actions are critical. He points out that the labor market has slowed and businesses are cautious, reflected in the ISM being below 50 for nearly 3 years straight. What changes that? Confidence. And confidence comes from the Fed signaling we're back in an easing cycle. In his view, rate cuts won't just lower borrowing costs, they'll re-inject optimism into CEOs and business leaders, encouraging expansion and growth. So where does Tom see the biggest opportunities if the Fed does cut? He looks at history, specifically 1998 and 2024, when the Fed paused and then cut in September. Based on that playbook, he highlights 3 trades: NASDAQ, 100, Big Tech. He believes this is the #1 trade. Rate cuts should give a strong boost to the Mag 7 and related growth names, crypto, Bitcoin, and Ethereum. This one is fascinating. Tom calls crypto monetary liquidity sensitive, meaning it reacts strongly to shifts in central bank policy. With easing on the horizon, he thinks Bitcoin and Ethereum could see monster moves in the next 3 months. He even describes this as potentially one of the standout trades of the cycle. Small caps and financials. Since these are more interest rate sensitive, they also stand to gain. But Tom is very clear. The first 2 trades, tech and crypto, are where he sees the standout action happening. Now let's talk about the crypto part, because this is where Tom gets really interesting. He explains that Bitcoin is extremely tied to monetary liquidity, while Ethereum has a dual role. It's partly liquidity driven, but it's also powering innovation on Wall Street through blockchain adoption and stablecoins. He even draws a historical parallel. He compares Ethereum today to 1971 when the US dollar came off the gold standard. That shift triggered massive financial innovation, and Tom believes Ethereum could play a similar role in this new era. So the takeaway is this: he sees crypto, especially Ethereum, not just as a speculative asset, but as the backbone of a new financial system. That's why he's so bullish on it in this macro environment. So to sum it all up, Tom Lee is painting a very bullish picture. He sees us still in the middle innings of a long bull market, with rate cuts set to broaden the rally beyond big tech. He thinks financials will start looking more like tech companies, and crypto could explode higher as liquidity floods back into the system. His top 3 trades: NASDAQ 100, Bitcoin and Ethereum, and small caps financials, with crypto and tech as the biggest winners. If you're watching the markets right now, the key theme from Tom's interview is clear. Don't get fooled by record highs. In his eyes, this is just the middle of the game, not the end. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into our first pick of the two AI stocks built for the long haul. Oracle, ticker ORCL, a company that's been quietly reinventing itself while the world was watching flashier tech names. You might know Oracle as an old-school database company, a pillar of enterprise software for decades. But dismissing them now would be a huge mistake because Oracle is undergoing one of the most impressive transformations in tech. Oracle has made a massive push into cloud infrastructure with Oracle Cloud Infrastructure, or OCI, and it's not just a side project, it's the new engine of the company. Unlike generic cloud services, OCI is purpose-built for high-performance AI and machine learning workloads. Oracle's focus is on speed, reliability, and the kind of scale that modern AI demands. Training large language models like ChatGPT requires immense computing power, specialized hardware, especially NVIDIA GPUs, and ultra-fast networks. These aren't just nice-to-haves, they're essential for the next generation of AI breakthroughs. Oracle was among the first to offer bare metal access to NVIDIA's top chips and engineered their network for ultra-low latency. This technical edge is a game-changer for companies building advanced AI. This means AI companies can train models faster and more efficiently on Oracle's cloud, reducing costs and accelerating innovation. For startups and established players alike, that's a huge advantage. The market is taking notice. Oracle recently signed over 30 AI contracts in a single quarter, worth more than $12.5 billion. These aren't just small deals, they're with some of the most ambitious AI companies in the world. That's not just revenue, it's a tidal wave of demand for their AI cloud services, signaling a fundamental shift in how businesses are thinking about their technology partners. Companies are lining up for Oracle's infrastructure because it gives them a competitive edge. In today's world, whoever can build and deploy AI faster wins. The more AI customers Oracle signs, the more they invest in new data centers and high-end chips. It's a virtuous cycle, growth fueling more growth. Their contracted backlog of future revenue has skyrocketed to over $98 billion, nearly double from a year ago. That's a staggering number, and it shows just how much confidence customers have in Oracle's future. That's insane growth and provides clear visibility into future earnings. For investors, this kind of predictability is gold. Oracle's cloud infrastructure revenue grew 42% year-over-year last quarter. Startup-level growth from a legacy tech giant. It's rare to see this kind of acceleration from a company of Oracle's size. They're taking market share from Amazon AWS, Microsoft Azure, and Google Cloud. The big three are finally facing a real challenger, and Oracle is making its move. But it's not just about AI training. Oracle's core enterprise software is also benefiting, as more companies look to modernize their operations with AI-powered tools. They're integrating generative AI features into their entire suite, from finance to HR to supply chain. This isn't just a gimmick, it's a fundamental upgrade to how businesses operate. This makes their products stickier and gives them a powerful upsell opportunity to their global customer base. Once a company adopts Oracle's AI features, switching costs go up dramatically. Imagine being a major corporation already running on Oracle. Now you get powerful AI tools seamlessly integrated. It's a no-brainer, and it's driving a new wave of adoption. This dual-engine approach, explosive AI cloud growth, and a revitalized legacy business, makes Oracle so compelling. It's not just a bet on the future, it's a company with deep roots and new branches. You get the best of both worlds, high growth and a stable foundation. That's a rare combination in tech, especially as markets get more volatile. Even after a strong run-up, Oracle's valuation remains reasonable compared to other large-cap tech and AI players. The market hasn't fully priced in their transformation yet. You're not paying a wild premium for this growth. In fact, you're getting a discount to many of the high-flying AI names with less risk. You're buying a company with a proven track record, a legendary founder in Larry Ellison, and a clear growth trajectory fueled by AI. Ellison's vision has kept Oracle relevant for decades, and now it's paying off in a big way. Oracle is also shareholder-friendly, paying a consistent and growing dividend. That's income you can count on, even as the company reinvests for future growth. Management is disciplined and committed to returning value to shareholders. Their capital allocation has been smart and focused, balancing innovation with financial responsibility. The moat here is real. Building massive, specialized AI data centers costs billions and requires deep expertise and supplier relationships. Oracle's scale and experience give it a huge advantage. This isn't something a startup can replicate overnight. The barriers to entry are enormous, and Oracle has already cleared them. Oracle has spent years and billions laying the groundwork, and now they're reaping the rewards. Their early investments are turning into a powerful competitive moat. They have a significant head start in high-performance cloud, and their infrastructure is only getting stronger as demand grows. Don't see Oracle as the company it was 20 years ago. See what it's becoming, an essential high-growth enabler of the AI revolution. The company's DNA is changing, and it's all about the future. The numbers don't lie: exploding backlog, off-the-charts cloud growth, and deals with the biggest names in AI. Oracle is now a critical partner for the world's most innovative companies. This is a long-term compounder hiding in plain sight. The market is just beginning to appreciate what Oracle is building. The risk-reward profile is incredibly attractive. You get exposure to AI, but with the safety net of a profitable, established business. The downside is cushioned by their profitable legacy business, while the upside is tied to the explosive growth of AI. It's a rare combination that's hard to find elsewhere. They have the technology, the customers, and the momentum. Oracle's ecosystem is only getting stronger as more companies join the platform. This is a stock you buy, put in your portfolio, and feel confident holding for the next 5 to 10 years. It's a true compounder for patient investors. Oracle's transformation is real, and the market is just starting to catch on. The next phase of growth could be even more dramatic. If you want exposure to the AI megatrend with a company that's both innovative and stable, Oracle deserves a serious look. It's a rare blend of old-school reliability and cutting-edge technology. Their infrastructure is becoming indispensable for the next generation of AI. As AI becomes more central to every industry, Oracle's role will only grow. As more companies race to build AI capabilities, Oracle stands to benefit at every stage, from infrastructure to software to services. Their partnerships with NVIDIA and other chipmakers only strengthen their position. These alliances ensure Oracle stays at the forefront of AI hardware and software innovation. The AI revolution is just getting started, and Oracle is right at the center. Their global reach and technical expertise make them a foundational player in this new era. Don't overlook this tech giant. It's quietly becoming one of the most important players in AI. The next time you hear about a breakthrough in AI, there's a good chance Oracle is powering it behind the scenes. The future of AI infrastructure is being built now, and Oracle is leading the charge. Their investments today are setting the stage for decades of growth. For investors seeking both growth and stability, Oracle is a rare find. It's a company that can weather storms and capitalize on new opportunities. Their strategy is working, and the numbers back it up. Every quarter, Oracle is proving the skeptics wrong. Keep an eye on Oracle. It's a stock with staying power. As the AI wave builds, Oracle is positioned to ride it higher. That's why it's one of the only 2 AI stocks you need to know about. Oracle is no longer just a legacy name, it's a leader in the new AI economy. Let's move on to our second pick. Our second AI powerhouse is Broadcom, ticker AVGO, a company that's the backbone of the digital world, yet flies under most investors' radar. Despite its low profile, Broadcom is a giant in the tech industry, with a reach that extends into nearly every corner of the digital landscape. If Oracle is building the stadiums for AI, Broadcom is the high-tech steel and wiring holding it all together. Their technology forms the critical infrastructure that supports the entire AI ecosystem. They're giants in both semiconductors and infrastructure software, playing a critical role in the AI boom. Their dual focus allows them to innovate and lead in multiple areas simultaneously. On the hardware side, Broadcom designs the world's most advanced networking chips. These chips are the unsung heroes of the digital age, enabling the rapid data transfer that modern applications demand. When data centers train massive AI models, thousands of GPUs need to communicate at lightning speed, and Broadcom's chips make that possible. Their technology ensures that data flows seamlessly, enabling faster and more efficient AI training. They dominate the market for high-bandwidth Ethernet switches, essential for AI data centers. These switches are the backbone of any high-performance computing environment. As data centers upgrade for AI, they turn to Broadcom's technology. Their products are trusted by the biggest names in tech, ensuring that they remain at the forefront of the industry. Broadcom also excels in custom silicon, partnering with hyperscalers like Google and Meta to design custom AI accelerator chips. These partnerships are a testament to Broadcom's expertise and innovation. For example, Google's TPUs are a collaboration with Broadcom, a high-margin, high-demand business. This collaboration highlights Broadcom's ability to deliver cutting-edge technology that meets the specific needs of its partners. So, Broadcom wins whether companies buy off-the-shelf GPUs or build custom chips. This flexibility allows them to capture a larger share of the market. This diversification within AI hardware is a massive strength. It ensures that Broadcom remains resilient and adaptable in a rapidly changing industry. Now let's talk software. Broadcom's acquisition of VMware was a game-changer. This strategic move has significantly expanded their capabilities and market reach. VMware lets companies manage private data centers and clouds, crucial for industries that can't put sensitive data on public clouds. This capability is especially important for sectors like finance and healthcare. With VMware, Broadcom offers a complete solution: top-tier networking hardware plus the software to manage it all. This integrated approach simplifies operations and enhances efficiency. This is perfect for enterprises building private AI clouds in-house. It allows them to maintain control over their data while leveraging the latest AI technologies. Broadcom bundles VMware's capabilities with their hardware, selling a full private AI cloud solution. This bundling strategy provides a one-stop shop for enterprises looking to build robust AI infrastructures. CEO 𝗗𝗚𝗏 is a master at integrating acquisitions, cutting costs, and focusing on the most profitable customers. His leadership has been instrumental in Broadcom's success. This disciplined model generates enormous free cash flow. Broadcom's financial health is a testament to their effective management and strategic planning. Financially, Broadcom is thriving. Their latest quarter saw $3.1 billion in AI-related revenue, with full-year guidance raised to over $11 billion. This impressive growth underscores their pivotal role in the AI industry. Demand is accelerating faster than expected. This surge in demand highlights the increasing reliance on AI technologies across various sectors. Broadcom is a cash-generating machine, with phenomenal margins and a strong commitment to returning capital to shareholders. Their financial strategy ensures that investors see consistent returns. They pay a significant growing dividend, making them a rare blend of growth and income. This makes Broadcom an attractive option for a wide range of investors. The valuation may seem high, but the quality and growth justify it. Broadcom's consistent performance and strategic positioning make it a worthwhile investment. Integration of VMware is ahead of schedule, with synergies flowing to the bottom line. This successful integration is a testament to Broadcom's operational excellence. With near monopolies in key hardware markets and a brilliant software strategy, Broadcom commands a premium. Their dominant market position is a significant competitive advantage. Their moat is immense. Competing in high-end networking requires astronomical R&D, and VMware is deeply embedded in thousands of enterprises. This creates a high barrier to entry for potential competitors. Switching away is costly and difficult, creating a sticky customer base. This stickiness ensures long-term customer loyalty and recurring revenue. Investing in Broadcom means owning a company essential to the digital economy. Their technology is foundational to the infrastructure that powers our digital world. They're not just riding the AI wave, they're making it possible. Broadcom's innovations are at the heart of the AI revolution. Their tech is indispensable for building both public and private AI data centers. This versatility makes them a critical player in the AI ecosystem. With visionary leadership and a fortress-like business model, Broadcom is a stock you can confidently hold long-term. Their strategic vision ensures sustained growth and stability. As AI adoption accelerates, Broadcom's role only grows. Their technology will continue to be in high demand as more industries adopt AI. Their unique position in both hardware and software gives them unmatched leverage in the AI ecosystem. This dual capability sets them apart from competitors. Broadcom's growth is sustainable, backed by real demand and recurring revenue. Their business model ensures long-term profitability. For investors seeking exposure to the AI megatrend with a company that's both innovative and resilient, Broadcom is a top choice. Their track record speaks for itself. Their technology is at the heart of the AI infrastructure build-out. Broadcom's products are essential for the next generation of AI applications. As more companies invest in AI, Broadcom stands to benefit at every level. Their comprehensive product lineup ensures they capture value across the entire AI supply chain. Their partnerships with the biggest names in tech only strengthen their dominance. These collaborations are a key driver of their success. The future of AI depends on companies like Broadcom. Their innovations will shape the next wave of technological advancements. Don't miss out on this essential player in the AI revolution. Broadcom is a cornerstone of the digital future. Broadcom is more than a semiconductor company, it's a critical enabler of the digital age. Their technology powers the infrastructure that supports our connected world. Their strategy is working, and the numbers prove it. Broadcom's financial performance is a testament to their effective execution. For long-term investors, Broadcom offers both growth and stability. Their consistent performance makes them a reliable investment. That's why it's one of the only two AI stocks you need to know about. Broadcom's unique position in the market makes it a must-have for any AI-focused portfolio. Now let's talk about your next move. Understanding the potential of companies like Broadcom can help you make informed investment decisions. So there you have it, Oracle and Broadcom, two titans providing the critical infrastructure for the AI revolution. These companies are not just players, they are the backbone of the digital transformation we are witnessing today. These aren't speculative bets, they're long-term investments in the foundation of our digital future. By investing in these giants, you are essentially betting on the continued growth and evolution of technology. While others chase flashy AI apps, real wealth is built by owning the companies laying the groundwork. These foundational companies ensure that the infrastructure is robust and ready for future innovations. Oracle is capturing high-performance computing demand. Broadcom is the essential connective tissue. Together, they form a powerful duo that supports the entire tech ecosystem. Adding these two to your portfolio is a strategic way to get solid long-term exposure to the AI megatrend. It's a move that aligns with the future trajectory of technology and innovation. If you want to level up your investing skills, check out my Value Stocks Investing Master Course, link in the description. This course will provide you with the tools and knowledge to make informed investment decisions. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon community. It's a great way to stay ahead of the curve and get insights that you won't find anywhere else. Now I want to hear from you. Between Oracle and Broadcom, which business model do you find more compelling for the long run, and why? Your insights could spark an interesting discussion. Let me know in the comments. Your feedback is invaluable and helps shape future content. Don't forget to like, subscribe, and share your thoughts below. Your engagement helps us grow and reach more people. Thanks for watching, and I'll see you in the next one. Stay tuned for more insights and updates.